What's going on, guys? Bexio back, and today we got a brand new video looking at the stock market and if it can get much worse from here. There's a lot of things going on in the economy that would say things are probably going to get a little bit worse. And just looking at the charts, we know that the only index that isn't in a bear market is the S&P 500, which is not down about 20% yet, but it is very close and showing that the worst could still be coming because it is still just in correction territory, even though so many things are just not going right now. One of those things being real estate. We can see right here that the mortgage demand falls to the lowest level in 22 years amid rising rates and slowing home sales. So not really anything crazy. I think we're all expecting this. Prices absolutely exploded in the past 2 years. And now with rates going up, the cost of a mortgage is way more than it was just even last year or even just a few months ago because of the rate hikes. We can see right here, it talks about the average contract interest rate for 30-year fixed mortgage with conforming balances increased from 5.4% to from 5.33%. So these rates are in the 5%. These rates used to be in the 2%, maybe 3 at the highest just a year ago. And now they're this high. So for the same price house, you're paying a lot more. The payment goes up every month. It's like a few $100s more that you would pay just for a 2% increase in the loan. So that's going to make people not want to be buying houses so much. Maybe you rent until you're hoping the price of the houses go down. I don't think that's going to happen. We haven't seen like a surge in real estate supply. So these prices might not really come down. You can also see applications for a mortgage to purchase a home fell 7% for the week and were 21% lower than the same week a year ago. So almost a quarter of the people that were getting mortgages stopped getting mortgages. So it's the housing market cooling off at least. So these prices, even though there's not much more supply, buyers are dwindling out. So prices may be stagnant, maybe move down a little bit. I don't think they're in collapse like people are saying because there's just not a huge influx of supply of houses. If that does happen, then prices will collapse in real estate because there's no buyers and there's going to be a ton of supply. But right now, we're not seeing that. We also see refinance, which no one's going to refinance now. Rates are going up, but that demand dropped 6% for the week and down 75% year over year. That one makes sense. Like people aren't who have a house are not going to refinance for a higher rate. That just doesn't make any sense. Why would you do that? So they're just not going to refinance. That brings down the kind of mortgage stuff. Everything going on with mortgages brings it down. Refinance definitely a falling mark. I mean, almost everyone's out of that, 75%. So all of this makes sense though. Right now, real estate is definitely a lagging kind of market because it moves way slower. These rate increases that they're doing right now don't really affect the market until the next 3 months because people who were locking in mortgages before are locking in at the previous rate. When they increase rates, that doesn't affect that affects the buyers now, and you don't get that data for another 3 months. And also with the real estate market, we have lumber prices falling pretty heavily. We know that it had an absolute explosion to like $1,700. And that was because there was so much demand in real estate, so much demand to build new houses. Now that demand's going away. It's down from 1,700 to 564. So still above kind of the mean of where it was for the last couple of years, like during 2019, 2020. But it's severely down from 1,700. Less demand to build houses, less demand for houses. That affects construction businesses and the workers in construction, which is a large part of the economy. They start going down. That pretty much shows the health of the economy. If people aren't wanting to build houses and spend money that way, then the economy is probably not in the best spot. And there's even a chart for that, which is the consumer sentiment chart. So for this, for the 100 level, that means, they're pretty good, very confident consumers. That's a strong economy. When it's around the 80 level, that's usually all right. It's not the best, not the worst, kind of in the middle. No, it's not. It's nothing terrible, just average. When it's at 60, that's when things are really bad. That when consumers have no confidence in the economy, no confidence in what's going on with their money, and they're worried about all this stuff, that's when things are the worst because they stop spending money. And if that happens, then the economy just gets absolutely obliterated. And we see the last time we were at these levels was the great financial crisis. It lines up perfectly. People were the most worried here, and they're the most worried right now. So could this be a leading indicator into kind of the market and where things are going to go for maybe the next year or two if we drop into recession and people continue to not have confidence in the economy, confidence in leadership, and all this stuff keeps getting worse? Then we even have stagflation on top of that, which basically just means we have high inflation with a stagnating economy. And in this part, we would have high inflation with a collapsing economy. So it would be absolutely terrible. And the worst combination you could get is people can't even afford to just buy food or their regular necessities, things to just live become extremely difficult to afford, and the economy is collapsing, so things just get into massively bad time. And from a poll, we have 83% in the survey say the U.S. economy is poor or not so good. That, almost everybody. That's literally 83%. That's ridiculously high of people saying U.S. economy is not good. Things are not going good. It's, we have stagflation really going on right now, which is the worst kind of thing you want. You don't want stagflation ever. But you have 83% of people saying the U.S. economy not in a good spot. And it's proven by things like this: Stitch Fix laying off 15% of their salaried employees. We had Uber freezing hiring, Coinbase freezing hiring and stopping and not accepting people they already accepted, Tesla planning to lay off 10% of their workforce. So many people coming out planning layoffs or laying off people. Things are not good. Money is not flowing. People don't have money. Inflation is wrecking people. We get the data tomorrow on that, and that's probably going to be severely bad, as we had tweets from the White House or stuff saying that it's going to be bad, expected to be bad. So nothing really looks good. There's no good news coming out anywhere right now. So, and if we look at the stock market right now, we can see something like this. This is the S&P 500 right here. So we can see every single time there's this drop, little rally, no confidence, goes back to a drop. Little rally, no confidence, drop. Are we seeing that yet again? That's why there's no confidence in this market. We have this rally, little rally up, kind of trading sideways, waiting on this CPI data, inflation data, see what it says. It's probably going to be pretty bad. The White House said expect high numbers. If we get over 8.3%, markets are going to dump. If we get under 8.3%, maybe it hangs on. If we get well under that, we're not going to, because they sent out a warning. So we're not even going to get that. But if we get less than that, like 6%, markets will rally. But we're looking at high inflation. So this is probably going to dump yet again. So it's the same story over and over again here, where we get a rally, dump, rally, dump, rally. We're probably going to see another dump. And there's nothing good going on right now. And even worse, we have 42% of buy now, pay later users made late payments towards those loans. That is not a good sign at all. Almost half of the people using those platforms made late payments. So they're buying things now that they can't afford, and then they can't afford the payments and make late payments. Wait until these late payments turn into no payments. And then these companies that are worth lots of money, things like Affirm, that's $1 billion company. If they don't get their payments and they go insolvent and they drop and go bankrupt and just are not, feasible for them to keep operating because no one's paying them, they have all these loans out, is that going to be the big cause for a massive type of recession where, these are kind of loans that these companies gave out, like in the 2008 recession, kind of the housing market kind of really failed and collapsed. We had Lehman Brothers, all these big banks going under. Are we going to see that with these buy now, pay later platforms where they go under, and them going under because they're worth so much money? Them going under just has ripple effects in the economy and in the stock market, in all financial markets. So right now, no good news. So how is the market supposed to rally with literally no good news? There's nothing positive coming out. There's just going to be looking towards safety is where anyone should be kind of going right now. Risk on is not the move. Safety is the move. People are going to be going into big tech, things like Apple, Microsoft, these companies, Google that can come through. They've seen recessions, they've seen tough times, and they've made it through. They've got the money to make it through anything. These other companies that don't have that kind of money to kind of get through a year, 2 years of bad times, those companies are going to be in trouble. And companies that are buy now, pay later, they seem to be in the worst spot. So we'll see how it all plays out. It'll come down to the CPI data coming out on Friday, which we've already been warned is bad. So things are probably going to dump pretty hard on Friday, and it's going to ring all of the bells that we're in recession, doing all this stuff, and we got stagflation, and things are just going to continue getting worse. So things are going to get worse before they get better, but at some point they do get better. The average recession lasts 6 to 18 months. So maybe 2 years from now, things will be on the up. That's going to do it for this video, guys. As always, remember to smash the like button and subscribe on the road to 1,000 subscribers. I'll see you guys in my next video.